So following US Fed speech, 10-year yield rose to 4.19%. Its India counterpart too was seen rising. Therefore, is there a case building to invest more in near to long-term debt funds? As inflation continues to haunt global central banks, it is pretty evident that rate hikes could go on. Now, to help us understand all of this and how to build your fixed income portfolio today, we have on board Nippon India's mutual fund CIO of fixed income investment, Amit Tripathi. Amit, good evening and welcome to the show. So clearly, let's start with the Fed's policy announcement. The Fed's policy announcement and Chairman's statement, that was a complete U-turn. Looks like the Fed is not in any mood to hit the pause button anytime soon. Now, looking at the rate hike scenario, how do you analyze this? Because despite the rate hike, no immediate relief is seen.
Yeah, hi, good evening. Thanks for having me here. You're right. There was a bit of a difference in terms of the written word versus the oral word, as in the statement did hint at some kind of whatever the market has been searching on in terms of a pivot, versus the oral statement did not follow through. I guess there are three parts where the market was looking at the Fed statement. One was how fast will they go from here on. Second was how high will they go from here on. And the third was how long will they stay there. In terms of the pace, there is enough hint to say that they might slow down the pace going forward. But in terms of the extent and whether they intend to stay in that restrictive zone for a long period of time, the market got disappointed with what the Fed seemed to suggest, wherein they said that their terminal rate expectations are slightly higher than what it was in September. And they may need to stay at those levels for a longer period of time to ensure that inflation is firmly under control. With this kind of a backdrop, obviously the terminal Fed funds rate expectations have inched up a little bit, slightly above 5% from slightly below 5% earlier. There was a section of market which was obviously hoping that the pivot would come closer to 4.5%. I guess that's not what came out in the Fed speech yesterday. The other thing that also I need to highlight here, while everything seems to be very negative and gloomy in terms of the statement yesterday, or rather in terms of the speech yesterday, very important for us to understand what the Fed has done yesterday is create space for itself. As in, by making the statement that it made in terms of looking at cumulative rate hikes, in terms of potentially slowing down the pace, etc., they are making themselves more data dependent. We have seen certain indicators in the US economy point to a slowdown. Unfortunately, from a Fed's perspective, that has not yet translated into either employment or inflation. And that is why they are not in a position to create some kind of a pivot that the market is hoping for. But at the same time, they do believe that this will eventually seep in. And whether this seeps in over the next, or in this quarter itself, or whether they start seeping in the next quarter, will depend or rather will decide on what they do going forward. So, in a nutshell, on one hand, while they were hawkish in their speech, but they have opened up the room is how I would look at this entire piece.
We can see Fed stand being very strong on its stance right now. But then what's the reason behind the rate impact not showing up, Amit? How do you analyze that?
I guess there are always leading indicators and there are always lagging indicators. I don't think inflation and employment as such are leading indicators. They are fallouts of a slowdown in activity. They are fallouts of many other leading indicators, some of which have already started showing up. So you are seeing slowdown in housing activity, for example. You have seen slowdown in commodity prices. You are seeing improvement in supply chains. On the flip side, consumer demand in the US remains very, very strong, which means demand is not slacking in at a pace at which the Fed might have hoped. You are still seeing job vacancies being very high, which means that wage pressures may continue for longer than what was earlier envisaged. So there are some leading indicators that are already showing a slowdown, but let's be honest, from a central bank perspective, which was behind the curve to start with, along with a huge amount of fiscal stimulus that was put into the US economy last year, things do take time, and possibly part of Fed reaction that we saw yesterday is to do with the fact that while they have been very, very aggressive in rate hikes in the last 6 months, they might have started 6 months too late, which is why you have to grin and bear for that matter for the next 3 to 6 months for some of these signs to get more crystallized for the Fed to actually start feeling comfortable. So I think it's more of a timing issue rather than an eventuality that we are talking about here. It's not about levels any longer. US 10-year yields at 420, as you rightly said, US 2-year yields at 470 necessarily mean that we are not really worried about the sufficiency of levels. It is about how long do we take before the market starts stabilizing is the bigger issue rather than the attractiveness levels as we speak right now.
Amit, while Fed decision to continue the rate hike is still there, the RBI too has missed its inflation target. And this is the first time the Reserve Bank of India is writing such a letter after the country switched to a flexible inflation targeting regime and formed a committee in 2016 to set interest rates. Now, India's October rainfall was around 44% above normal. The 3 months average food CPI was a whooping 10.9% as against 4.9% in the preceding 3 months. Now, this indicates that unseasonal rains may have a large negative impact on food inflation in the coming months, creating further concerns ahead of the meet. What do you have to say on this, and how much pain for individual is ahead in terms of high inflation do you see?
Again, to break it down into 2 or 3 sub-components, which is very important here, the stickiness in inflation that we have seen through this year has been more in terms of core. The food inflation, like you rightly pointed out just now, has been somewhat seasonal and to some extent erratic and possibly accentuated in very recent times because of uneven or delayed monsoons. That is having a direct bearing in terms of some seasonal price fluctuations, including that of fruits and vegetables. But again, to keep in mind that if we are looking at the picture 3 to 6 months here on, we are not too worried about inflation overshooting RBI's projections. RBI has projected 6.7% on the whole. We believe that they will be able to meet that. In fact, as we go into next year,
what are the triggers and parameters on the basis you're saying this? How would you help us understand that?
So it is very clear. So the 6.7% number has been arrived at based on the quarter-on-quarter projections that the RBI has done. We are looking at below 6% kind of a number or closer to 6% number in the fourth quarter, which would lead to average inflation this year of around 6.7%. So in fact, what happened was in the last quarter, the quarter just gone by, the actual numbers of inflation that came out were actually lower than RBI's own projections.
Got it. So, talking about currency, dollar softened after the Fed rates announcements, but this doesn't look like it's going to sustain for a very long time. When do you think the RBI will be uncomfortable and will actually take stern steps to control the weakness in the currency?
So very frankly, I think the RBI has allowed the currency to settle down on its own once it's crossed 80. Where we see the currency in terms of performance, YTD, you are still above median in terms of performance within the developing market pack. Within Asia, you are still one of the better performing currencies. So we really don't think at the levels where we are right now is too much of a worry from a relative perspective. Everyone has seen a depreciating trend against the dollar, and so have we. I think the worry would arise only if we are depreciating in isolation, which does not seem to be the case. On the other hand, if you actually look at the larger big picture, we would tend to believe that a larger part of dollar strengthening has already happened. And as we go into the future, you might actually see these trends stabilizing rather than seeing a similar kind of stress over the next 12 months as we have seen in the last 12. So to that extent, I think till the time we are not depreciating in isolation, I don't think the RBI would be too worried with this trend because we are still one of the better performing currencies in the overall market.
So now, if inflation is not a very major concern, how do you think RBI is going to keep track of the raising interest rates that are happening in the US? What kind of a tone you think RBI is likely to adopt in the coming policies?
If you actually look at the MPC minutes that were released after the last policy, I guess some thought process that we saw in Fed statement yesterday was coming through in that MPC policy minute also, where actually members are of the opinion that you have raised rates from an effective overnight rate of 3.35% to an effective overnight rate of above 6% already. Is it time to pause and see how is it impacting real economic conditions? That would have been a normal way of going about it, but like you rightly said, given these pressures that are building in because of other central bank action, including the Fed, and given the residual risk that you rightly pointed out, so if you ask me, what is the one risk that the market is worried about right now in the overall scheme of things, it is that currency unhinging. We have not seen it till now, not a sign of worry till now, but that's the residual risk or the tail risk, so to say, that the market is worried about. Given this backdrop, we believe that while the market is pricing in a terminal repo rate of 6.5 to 6.75, the RBI will eventually reach in that range over a period of the next 2 to 3 policies. So we believe that whatever the market is pricing in right now is where the RBI will eventually end up, which is a range of 6.5 to 6.75, give or take 10-15 basis points.
Also, one thing, a couple of reports that I've been reading and going through, the pinch of inflation is not yet felt because we are seeing a overhang of post COVID effect, in terms of demand, in terms of consumption. There's still some steam left. Do you think now the pressure would just slowly build up on consumers in terms of demand and consumption? Do you see that dip coming soon now in few quarters?
So, I think what you're referring to is the demand of consumers coming down because of high inflation or higher prices. Is that what your question is?
Right.
So at the margin, it has not been felt because of 2 or 3 reasons. One, the excess savings that had been built in during the COVID times, not as pronounced in India as the US, for example, but even here there is some pent-up demand that is played through. Second, has been a reasonable nominal wage increase that we have seen at least in urban spaces, in the salaried space, etc. So that demand has also come through. But would tend to agree with you that as we go into the next 12 months, with the kind of incremental slowdown that we are likely to see, for example, in hiring in some of the big employment areas, especially on the urban side, we will likely see some amount of demand slowdown coming through. And also the fact that at the margin, inflation will start pinching as far as concurrent expenditure is concerned. But I don't think there is too much of worry on that side because the consumer balance sheet in India is still in reasonable shape. Savings would have come down, but they are still in reasonable shape, so to speak. So we do see a softening, but we don't see demand falling off the cliff, so to say.
So, Amit, in a nutshell, how do you make sense of this entire situation in terms of bond yield scenario? You think the further rate hikes are already factored in? How should an investor approach the deployment of their funds if you talk about debt?
Honestly, this is more a situation of the yield attractiveness versus volatility, and we are already in that territory where yields are starting to become very, very attractive from a long-term investment horizon perspective as well. Without getting to where the yields will peak out, whether we are 20 basis points away, whether we are 25 basis points away, let's look at the big picture scenario. 18 months back, the 10-year government security yield was 580. Today, you are at closer to 7.5 or above 7.5. Now, whether one argues that they will go to 775 and settle there, or whether they will settle in a 10 basis point range, hardly makes a difference to this big picture where yields have already moved up by 180 to 200 basis points. You look at the short end of the yield curve, the story there has been even more pronounced because of tight liquidity conditions having played through since the beginning of this calendar year, or rather this financial year. So in a nutshell, there is attractiveness in yields from a long-term investment perspective, but also there is this element of uncertainty which adds volatility. So the way to solve for this in our minds is very simple. If your investment horizon is reasonably long enough, for example, if you are coming into long-term bond funds, investment horizons typically of 4 years and beyond. If you are coming into intermediate duration bond funds, investment horizons of 2 to 3 years, if you have those kind of investment horizons, we think there is reasonable value in the market. The pockets where you might see still some more reaction, maybe somewhat in corporate spreads because of tightening liquidity conditions. But there also we don't see significant reaction because corporate supply has been pretty less. Unless that increases significantly, even that reaction would be muted, not more than 15-20 basis points incrementally speaking. So in a sense, the pricing is there, but volatility will be a feature in the next 3 to 6 months. So just be very sure of your investment horizon, and if your investment horizon is matching the profile that is required for a long duration product, especially a 3 to 4 year kind of investment horizon and longer, I think one should incrementally start adding in at this juncture and spread it out between say now and December or now and March.
All right, so that's the way ahead for your debt portfolio. And with that, thank you so much, Amit, for being on the show and helping our investors understand all the market triggers happening.